Hello everybody, in this video I will explain what is a mortgage. This is based on my personal experience, trying to understand a mortgage. If you want to buy a house for example, and you don't have all the needed amount of money, you need to find an extra amount of money. This amount can be found in different ways, but the most common one is to ask to a bank. The bank asks you some documents to check if you are able to pay back the debt. The bank also discusses with you the best possible mortgage to take. I will give you some tips in a minute. Once you have defined the amount, interest type, and the timing, the bank will give you the extra amount of money to buy the house. In other words, the bank sells you money, to get back some interests. It is an investment for the bank. Let's suppose that you have 20% of the money needed, and the bank gives you the needed 80% to buy the house. You have an equity of 20% and 80% is represented by a debt. If for example you decide to sell the house, because you got a much bigger offer for that house, then you simply give back to the bank the loan, and the rest of the money is yours. From month to month, with your monthly payments you give back debt quotes, so you gain more equity, reaching 100% once the residual debt reaches zero. From that day, goodbye to the bank, and the house is completely yours. But what if at a certain point you are not more able to pay the mortgage? If you don't have an insurance, or you don't renegotiate the mortgage, the bank will take your house and sell it to get back the residual debt. The problem here is that the house will be sold through an auction, and very probably the price will be lower than the price you paid, so you lose some money here. To avoid this, you can renegotiate the mortgage with the bank, having a lower monthly payment or a period without paying anything, to help you recover faster. The bank could apply a higher interest rate, but this depends from bank to bank. If you think you are not more able to afford that mortgage or house, you should sell your house with a good price, giving back the residual debt, before it will be sold through an auction. Numbers of a mortgage can be calculated with these equations. I will just show you an example. In this channel you can find other videos with more details about this. Here, we calculate a monthly payment of $555, having a loan of $100,000, an interest of 3%, and a 20 years mortgage. With this equation, we get a loan of $360,000, having a monthly payment of about $2,000, 3% interests, and 20 years mortgage. The monthly payment is composed by interests and principal. Every month, the interests are calculated on the residual debt. This whole plan is called amortization schedule. It gives you the details of every month. This is the typical monthly payment mortgage profile that graphically represents the amortization schedule. The red area is the money you lose in interests, while the blue area is the loan you are giving back to the bank. To choose the best possible mortgage, you have to take some important decisions. You have to decide how much of your net monthly income to use for the mortgage. You have to choose an interest rate, fixed, mixed, or variable rate. You have to decide which are your needs, avoiding to buy a bigger home that you don't really need. You have to decide the mortgage length. All these decisions combined together could let you save a lot of money. In this channel you can find another video with some details, if you like. What you should also do is comparing your mortgage profile with a rent profile. In some cases rent could let you save money. There's another video in this channel about this comparison, if you want. Thank you for watching Simple Money Tips. We are working on other business examples. If you have questions, write them down here. If you want, leave a like or subscribe to this channel. Thank you very much.